Welcome to Expanding Frontiers from Pearl Quest. I'm Kathryn Wilkens. Here, we explore the evolving edge of investing, data, and the frameworks that help us make sense of it. Hello, welcome everybody. I'm very pleased to have a guest, Javier Paz, today. He's the founder and CEO of RigorRank and one of the most rigorous analysts working in digital assets. He's spent more than 2 decades in capital markets research, including years producing institutional reports at boutique research firms before joining Forbes, where, as director of data and analytics for Forbes Digital Assets, he built the publication's annual ranking of the most trustworthy crypto providers, a 9-factor methodology that evaluated more than 600 exchanges on reserves, internal controls, regulatory compliance. His investigative work there traced real financial crime, from exchange collapses to cross-border money laundering. Today, through RigorRank, he has turned that discipline into an institutional intelligence platform that maps the digital asset ecosystem in extraordinary detail, a framework that has just expanded to 21 categories and 400 classification groups spanning entities, instruments, and even the academics shaping the field. So, Javier, welcome to Expanding Frontiers.
Thank you so much, Kathryn. It's a pleasure to be here.
Yes, we met at Consensus, a digital assets conference in Miami. And my goal there was to find out what I should be telling my graduate students in the fall about digital assets. And you remember what you said? You said to me, do you believe in...
You come to the right place.
Exactly. Yeah, so I'm so happy you're here. So let's start out by talking about your journey from Forbes to RigorRank. What pulled you into the digital asset space? What did your earlier work prepare you for in terms of moving to the digital asset space?
Right. Well, I was involved in institutional and retail trading across asset classes for this analyst firm based out of Boston. And we would write reports that would be consumed at the institutional level by the likes of Schwab, Fidelity, vendors who provide solutions to these front client-facing institutions, massive institutions. So we would help them keep the finger on the pulse and keep up with trends. Multi-asset trading is pretty common today, but back in 2010, it was not as common, and you had your dedicated stock traders and dedicated options trader, dedicated futures trading, and so I was looking at those different silos of trading from a business, technology, and regulation perspectives, and writing lengthy reports about them, So one of the trends that came about was multi-asset trading. Others were trading in more esoteric products like foreign exchange. There was also something called contracts for difference, CFDs, that was primarily developed outside of the US, in Europe and the Commonwealth countries. There was also copy trading. There was robo-advisory that emerged. So I would look at all those trends and write about them. And back in 2015 or so, it came into my radar. Bitcoin started to come under my purview, and then I looked further into it and see what was being built on. At the time, it wasn't known as digital assets as much. There was a company called Digital Assets that had its own DAML programming language, but it was a permissioned ledger kind of approach to trade to the technology. So we started to track and see, okay, at what point does this new technology symbolized or embodied by Bitcoin, start to impact or become relevant to institutions that I was writing for. And, so the thought is, okay, let's dig into it. That was in 2015. And I wrote about the top 10 permissioned and a couple of open chain infrastructure, among them Ethereum. That was, again, very nascent kind of period for them. You had Hyperledger Fabric, you had R3 Corda, you had digital asset, the AML language. You had also companies like Symbiont, Overstock had its own offering as well, and Axoni and DTCC was kind of getting in the picture, also experimenting a lot of proof of concepts for what was called distributed ledger technology, DLT, at the time. A lot of proof of concept again, but not so many going into production per se. So the permissioned part of the equation kind of fizzled out, or became less relevant. But while the open chain, blockchain, public blockchain, as well as the decentralized solutions, as well as middlemen and middleware that enhanced, that open architecture became more into focus. So over time, I saw that there was a lot of growth, and the learning curve for this technology was huge, was very high, and I got the sense that, okay, well, something is needed here to to understand what it is that we're talking about, and be able to explain it in simpler terms or more familiar terms to those who deal in very sophisticated areas of finance, but are not as familiar with the nuances, the esoteric aspects of digital assets. So that's where I developed an increasing level of interest in blockchain technology, digital assets, tokenization, stablecoins, you name it.
Yeah, the ecosystem is pretty complicated. So yeah, definitely a need for that. How about some of your reporting involved some genuine financial crime investigation? Did that like increase your conviction for the need for um, classification system?
Yes. So part of the work that I did at Forbes was that of an investigative reporter. Um, we uncovered what was I would characterize as very questionable / potentially criminal activity. In cases of wash trading, false representations, and part of those things had to do with reality in this marketplace, that you have even very well established firms today that start with an origin story that doesn't quite add up. After FTX blew up in 2022, I was interested in knowing how many tokens issued by Binance this company had, so the BNB token. And so I sent out a request for information to them. They didn't reply. And, a couple more times, still no answer. But they would answer other things. So I became curious because they had done something called proof of reserves. And that is something better than nothing, but it still leaves a lot of questions unanswered. And so essentially, I started on an 8-month journey to understand BNB and look through the passage of time, how BNB was created, minted originally in Ethereum chain, and then moved to something called BNB Beacon, a different chain that was more proprietary, not smart contracts, and then to something called BSC, Binance smart contract network. I had to rely on the help of one data company, Gray Wolf Analytics, who basically was able to do the heavy duty, tracking and quantification of tokens that basically we're talking about tens of thousands, millions of records on a single wallet, and for very small fractions of activities at a time. Potentially, I was able to do so much work looking at the browsers, at the navigating, what you can find out in something like the default chain navigator, but after that, you really needed somebody else to be a node to be able to pull all the information. So that process allowed me to focus on the narratives, the white papers, what we're saying, and then what the open ledger on Ethereum would say about it. And I started to see discrepancies in the narrative. So, for example, the white paper would say 20 million tokens of BNB will go to angels, success, and so those questions didn't quite add up, and so it was investigated, but it is one of those occurrences that makes you wonder, how does a narrative square up with the reality, that, to be measured on chain. But in order to measure it, you need a lot of patience, you need a lot of dedication, and sometimes some firepower from a data company to be able to support it. So again, that's kind of the potential for blockchain, is to understand get your hands dirty with blockchain data and how it's distributed, what is normal, what is unusual, and then be able to draw some conclusions from that, independently of what the narrative is. And that's something that fascinated me, that could be done. Now, as the technology is evolving into incorporating more privacy into this, on top of the cryptography and on top of the anonymization of wallets, if you add privacy to that and mixers, and lack of reporting and lack of transparency, that becomes a whole different animal that resembles more of the traditional OTC nature, where a bilateral transaction between Bank of America and Citi, or between JP Morgan and one of its own subsidiaries elsewhere, you're never going to know what happened there, because it's a bilateral transaction. It could be an internal ledger situation, so you're never going to know. And I think digital assets is gradually moving in that direction. So part of the reasons for coming up with this classification, which, by the way, that it was like an epiphany about a year ago. I was thinking long and hard how to give back some of that expertise that I had gained researching these type of entities. One of the reasons why I thought it was needed is because there is a natural opacity, lack of transparency in this so-called open architecture kind of technology. Companies don't talk too much about themselves, and sometimes when they speak about themselves, they do it in a way that is in platitudes or in aspirations, and not so much in terms of what they do. For example, Coinbase calls itself the exchange for everything, and that is, fairly indicative of how they view themselves in aspirational terms. But in reality, it is much different. If you're an analyst, or if you want to deal with Coinbase, for example, in Bolivia or in Argentina, you have to look at what Coinbase is authorized to offer in that particular country. And it may not be everything. It could be just a sliver of whatever else that they do. if you're an institution and you're wanting to deal with Coinbase for something other than exchange, say for example with for them to custody something for you, then you deal with Coinbase Custody, which is a different separate entity of Coinbase, a subsidiary, and it operates within certain jurisdictions, the licenses that it has in the US and in other jurisdictions. So clearly there's nuances where the vision of themselves and what they do in general, or in a specific geography, is bound by the legal entity as well as the licensing that they have. And so that's where me as a journalist, I wanted to understand, okay, so what are you authorized to offer in a particular jurisdiction? So I had to dig out normally legal entity names that may or may not be provided by the entity, but they're in the public domain. So I would research it, I would find it, and then verify it with the regulator, make sure that it's accurate, and then be able to piece together which are the collection of entities that, say for example, in the case of Binance or Crypto.com or Coinbase or a Circle, you have multiple entities, dozens of entities that they have each under a parental organization group, and it's good to know which entity does what under what license and in what jurisdiction. So that kind of mapping didn't exist. It is something new that we provided. But in order to, for example, to classify the 30 or 40 entities of a Coinbase, we have to recognize that each of these entities may be doing something different. So for example, a base, does decentralized work. Coinbase Custody does custody work. They have Coinbase Ventures, which does venture capital work, and so forth. So each of those entities has a different classification, but they're all fall under the umbrella of the larger global Coinbase entity, which is the parent group. So the classification system is an effort to understand what each of these entities does at a granular level. Mm-hmm. And so that if you're looking for entities that meet a particular criteria, you can search it as a professional, as a due diligence individual, or as an investor, a sophisticated investor. You can find, fairly accurately who does what in what space, in what geography. And it's a substantial amount of research that goes into that, but it starts with having a sound classification behind it. And that's where we came up with our own initial version of the RigorRank classification framework. Initially with 17 categories, right now is up to 21. We just added a few more that we're very excited about. Right here in the classification framework today, you can see 17 categories. And so here you would find the crypto exchanges, the custody firms, payment related done with digital assets, financial services, so funds and the like, market data and analytics, investment management, application and services, crypto professional services, so the accounting, taxes, audit services, mining, stablecoin related. This is tokenization. Okay, so this is the expanded platform. So let me show you. Current version actually has fewer categories. So there's law enforcement, public sector, on-chain investigations for many people who are scammed. So being able to look at, how to find resources in that space, it's particularly useful. Then you have real world tokenization, and look how simple it was. It is the current understanding of tokenization, if you will. It's relatively simple terms, And that's how we would describe it. Simple and not naive, but certainly,
Right.
partially developed. But if you go now to the tokenization platform, what you see is a much more robust type of understanding where, say, for example, well, different types of tokenized items are represented in more granular form. So there's government, I mean, anywhere from municipal bonds to treasuries tokenized, to corporate equities tokenized, to corporate debt.
So this area's gained a lot of attention, tokenization and tokenization of real world assets. But and in your white paper, you went through an example of Tesla in 5 forms. Part of your criteria was also like who owns it, is it transferable, and if it's transferable to whom, whose name is actually on the underlying asset. And when you were scrolling around here, I saw Seed and Co come up. I was wondering if you could talk a little bit about how similar how similar of a role they play in traditional finance and digital assets.
Right. So in traditional finances, traditional finance, it is still fairly complex, but at the end of the day, the ownership
Like maybe
is
just in terms of stocks.
yeah. So in terms of stocks, so there is a person's name or the vehicle that let's say, for example, if you're investing in an ETF, the ETF's name, would be registered with the CSD, which is the DTCC in the US, and they would handle name transfers when you sell your interest in that ETF or in that share. Now we're moving to a way of handling ownership in different ways. As we go into digital assets, both the DTCC version as well as the industry's solution gets much more complex because the current versions that maybe of, let's say, tokenized Tesla stock issued by Robinhood or issued by Coinbase or Kraken, they lack components. Like, say, for example, your name is not in the DTCC equivalent kind of record. You may have something that is not transferable, most likely, that is issued. It's like an IOU recorded online, and that IOU from, let's say, Robinhood gives you certain rights, but is nothing like the rights associated with the traditional finance way of doing things. So your name is not necessarily in the security that is used as collateral for that transaction. You can claim that collateral as your own just because it's used to in theory, to support the issuance of a tokenized version of that stock. So you're taking a leap of faith that the retail-facing institution and their version of this tokenized security is valid, and it grants you certain rights. On the finance, and others are looking to incorporate corporate actions in partnership with Broadridge, I believe. Corporate actions benefits to those tokenized solutions. And there are others like SDX listed here under 20, category 20, subcategory 5, SDX and Swiss DLT structured products, where it's a closer to your name being written on the security, so giving you more ownership, if you will, than having a tokenized version issued by an exchange, like or a financial intermediary. So in a way, the tokenization that is taking place today is akin to something that I covered earlier in my career, the contracts for difference, which are essentially IOUs. They're non-transferable. If the company goes under, so does you become a general creditor at best in for that particular stock, and you don't have many rights. It is not covered by insurance like SPIC. So there's a lot of limitations currently in what is being offered to retail users. So part of this categorization that we're doing is meant to reflect that complexity of, not every tokenized Tesla stock is similar. So that's where different tax rules, different geographies, different products, financial products differ. And that's where we wanted to highlight those differences as well.
Thanks. Yeah, so you might think you have a Tesla claim on the Tesla stock, and it's very different legally. Your legal status is different depending on where you bought it.
Exactly. So part of, for financial advisors, for example, they might be interested in our new crypto wrappers and structured products, which, break down ownership of funds, ETFs, ETPs, basically, and under different acts, different kinds of animals that are out there, and each of them, with their nuances. So we wanted to create something that can help individuals read and understand more about what exactly are they looking at. Something that you may or may not get from the prospectus associated with these entities. So it's certainly a lot of level of fairly intensive research that we've done to not only break down the categories, but also associate. Right now, you use these zero entities in this particular version, but pretty soon you would see specific names associated with them that's where having a sense for what is apples to apples comparison that you can make for these very peculiar instruments for sophisticated investors.
Yeah, and you hear an awful lot about things like tokenized real estate and other real world assets, but how big is it really compared to the whole space? Is it more
It's a long
aspirational?
tail of services, very esoteric. Um, you know, um, buyer beware, very liquid. But hopefully it has some of the key elements that make it attractive still, despite those limitations. But I think there is enough investment, I would say, in traditional finance entities for digital assets, proof of concepts, to more product building, and that's the part that is a little bit exciting, and sign of the times that this is not just noise like it was 10 years ago, but rather very concrete, early pioneering kind of investing, real money being deployed. And anytime you have companies like Fidelity telling its clients that a 3% allocation could be appropriate, in a typical portfolio, to things like their FBTC instruments or similar, crypto ETPs. That says a lot. That says that
Right.
retail investors, financial advisors, Morgan Stanley advisors now can tell their clients that a certain allocation is appropriate, and their clients have their own tax related, tax constrained investments that they're interested in. So these kind of sophisticated investments that grant different rights will become more and more relevant and important for
Mm-hmm.
the advisors, the CPAs, the tax advantaged professionals out there that need to be informed with this type of alternative investment.
Yeah, there's a lot of developments in this space for sure, and this is a um, useful classification system. Where can people find your work?
Just drop me an email on LinkedIn or Javier at RigorRank.com. That will usually get me.
All right, so we talked about tokenization, where it's heading, and where digital assets fit into. They're now saying that fits into alternatives allocation to some extent. What are your thoughts on that?
So as I mentioned, the Black Rocks of the world, Fidelities of the world, to the the most giant asset managers out there, they are speaking very highly of the crypto ETPs. The legislative work of brought by the Genius Act and potentially by the Clarity Act that is in Congress bodes well for the development, ongoing development of more products to meet the needs of investors, sophisticated investors. So I think the comfort level has rapidly increased anywhere starting with 2024, ever since the SEC threw his hand in the air and allowed, authorized, because of the courts, authorized the issuance of crypto ETPs, spot crypto ETPs. From then, we've seen a dramatic shift in the perspective of traditional finance that now in its second year is starting to gain more and more momentum, despite the ups and downs of crypto, particular crypto securities. We're currently going through a crypto winter. But despite that, there is enough interest, ongoing interest, that companies like Morgan Stanley just recently, while we were in Miami for Consensus, they announced that they had opened up for their vast financial advisor network to offer Bitcoin ETPs and other crypto ETPs to users, to their investors. So that's the beautiful thing that the institutional market can do. They're smart money, and they're looking to minimize risk. They look to ask questions, and that's in fact part of one of the things that I try to do in my previous work, which was basically is what would a sophisticated investor want to see or know or understand about crypto, about particular products and companies before they invested in something or partner with somebody, and that's where RigorRank serves a very unique niche of institutional due diligence.
All right. Is there anything else you want to add?
Well, I believe that the market at large is a terrain that is subject to a lot of illicit activities, and it is perpetuated and made more challenging than it should be, because there is a substantial learning curve associated with understanding how things work, and the animal spirit in this industry is one of build, launch before you actually have the proper internal controls, the proper regulatory guidance, or even a framework in which to operate. So they're very cavalier about launching a new product, a new service that later you find out, oh, we left the back door open, and some motivated North Korean hacker came in and grabbed what we had let investors invest in, and therefore the collateral that we thought we had is no longer there now. So that happens a lot. So there is a lack of maturity in how they are going about launches, and institutional investors have to understand that, check the controversies, and that's something we do at RigorRank as well. Is we check for controversies every entity or every individuals that we have there. We train our algorithms to look for specific criteria that is controversial, and it may or may not be a yellow or a red flag, but it is something that we believe that is glazed over or covered up very often themselves. So we feel our obligation to be different in that way, to have specific information like partnerships that they have in place, controversies that they have in place, as well as licenses, a description, an arm's length. There's description of who they are and what they do. And we also give input. We give a way for the company and the entities themselves to articulate in their own terms what they do, so that they can balance that with what we've gathered over the course of our research. So we believe that the fusion of those two things, their narrative as well as our rigorous research, yield a much more intelligent base upon which to have a good conversation in terms of internal controls or specifics that may serve a client's needs. So for those reasons, we see ourselves as being an advocate both with the institutional investors, with regulators, with law enforcement, and with industry to bring more clarity, more transparency where it's not natural for them to offer it. I think we believe that we're doing an important work in making conversations much more fruitful for the industry.
Right. So there's, I think I recall in the white paper you talked about, you only cover entities that meet certain criteria. And it kind of reminds me of our conversation at the conference when I asked you about meme coins, and like, they don't really meet the criteria, so they're not covered. Yeah.
Yeah, meme coins are more of a embodiment of speculation, obviously, and fun, because frankly, it's fun to bet on a meme just like you would bet on a horse or something else. It's pure speculation. It's nothing fundamental about it, but it is merely that it's the same thing as prediction markets, pure speculation. And but in the case of prediction markets, you have the possibility also of some people having material information before others, and that becomes an issue as well. That it doesn't conform neatly with our what we have allowed as investable products. Yes, we allow gambling, sports betting, to some extent, but we shouldn't call it a financial product, because it is something different.
All right. Well, thank you so much for your time. I'm so glad that you could join us.
My pleasure. Anytime we can revisit our conversations.
This has been Expanding Frontiers, a Pearl Quest podcast. Stay open to what reveals itself. Until next time.